Good morning, Brady.
Morning,
It's
Marie.
Brady and Marie. We're here to talk about reverse mortgages today. And I just have some questions that I kind of do a little high level overview on what a reverse mortgage is. And the first thing is I'm thinking about doing a reverse mortgage. And, I'm getting to the qualifying age for a reverse mortgage is 62. And so I wanted to ask you, what are the benefits of doing a reverse mortgage and when should I do it?
There's a long list of benefits, and I'm going to give a qualified answer to when you should do it. My default response to that is you should do it as soon as you qualify, as soon as you have enough equity, and as soon as you're old enough to do it, which is 62. There are some.
Okay, so talk about the equity. How much equity do I have to have?
At 62, you probably need around 65% equity based on current rates, 65 to 70. So what they will lend you is determined by your age, the value of the house, and interest rates. So interest rates bounce around a little bit, but study after study shows that you're waiting to get a higher percentage of the value of the home doesn't get you more money than starting earlier, because the amount that they will lend you grows over time, even when you start at 62. And study after study shows that it's quite unlikely, not impossible, because it's also dependent on appreciation and where interest rates go. But the neat thing about reverse is if you ever get into a position where you can actually borrow more than what you've qualified for at a younger age, then you can refinance and you don't have to pay that insurance. So there's an insurance premium that you buy when you get a reverse in case the reverse mortgage becomes worth more than the value of the home, because you never have to pay that. It's a non-recourse loan. So if you borrow a certain amount on a mortgage and you live till you're 106 years old and the reverse mortgage accumulates past the value of your home, you or your heirs will never be responsible to pay that.
Let's stop there, because this is one really important thing that I learned that was not happening back in I don't know when it was, the 70s or the 80s, when people were losing their homes because the value of the reverse mortgage exceeded the value of their home, and then they were losing their homes. So tell me about the protection that's now in place, because I think people are still really afraid to do reverse mortgages because they're afraid they're going to lose their house or their heirs aren't going to get their house.
Yeah, how specific do you want me to get about that? You want me to go into the details?
Just some of the details.
Right.
I mean, we don't want to go down the rabbit hole, but the high level.
Okay, so a lot of the misconceptions about reverse mortgages come from that. That actually wasn't true. They've always been non-recourse loans. The problem that they had in the past is that if I borrowed money in a reverse mortgage at age 63 or 64 or something, and my wife was 59 and she wasn't on the loan, if I died, then she would have to refinance. And if she wasn't able to do that, then she might lose the home. That has all changed. It's insured by FHA. It's regulated by the Housing and Urban Development Department of the United States government. That has been regulated out. So they now have a designation. If you're in that situation where one of you qualifies and the other one doesn't for age purposes or other reasons, then that's what's called an eligible non-borrowing spouse. So if I'm 62 or 63 and my wife is 59 and I get a reverse mortgage only in my name because I'm the only one that qualifies, if I die before she does not have to refinance the home. The loan will stay in place. The only thing that she would lose is access to any line of credit that I hadn't taken out. So if I had a buffer of a line of credit in that reverse mortgage, I would have access to that if I'm the one on the loan. She would not, but she is not required to sell the house or move or anything in that situation. So it's been HUD and FHA and the CFPB have gotten involved, and they've made these very airtight. They're very poorly understood, but they have some really neat benefits.
So let me ask you this: if you have a spouse that does qualify, you should both be on the loan, and then you're both qualified. Can a non-qualifying spouse be on the loan, or is that anybody who's on the loan has to be 62?
So they're mentioned in the loan as the eligible non-borrowing spouse is what that's called technically. So that's the person that can stay in the home if the person on the loan passes away. So in the example that I gave, my wife would be listed on the loan as the eligible non-borrowing spouse, but she wouldn't be the borrower because she wasn't eligible when we applied. Now, all else equal, it's better to have you both on, because I mean, the only difference in the scenario that I mentioned and the scenario where we're both on the loan is that she would have access to any of the untapped line of credit, which is a huge deal, by the way. And I think, well, that's another story, but that could be a big deal if I've got untapped line of credit. She may want to access that when I'm gone. But if she's an eligible non-borrowing spouse, that ends at my death. So if there's any line of credit that I haven't used, but I could literally max out my line. If I was terminally ill, I could literally max out my line of credit, give it to her, or it would be joint property because we're married. And then I pass away and she's got that cash in the bank.
She's got the cash available.
Yeah, so it is just one, that's the major difference between an eligible non-borrowing spouse and an actual borrowing spouse. The other difference I should mention is that an eligible non-borrowing spouse, because the reverse mortgage, the lender, the bank, they know that if my wife is 30, her lifespan is significantly longer than mine if I'm 62. So they're going to lend less, right? They're going to base how much they will give me in a reverse mortgage based on her age, not mine, because she's the younger of the two. So in that case, there's some financial strategies you could do to try to get around that if you're married to someone significantly younger than you. But for the most part, the best outcome is if if one spouse is 63 or 62 and the other 61, it would be worth considering waiting until the youngest one is 62, just so that you're both on the loan, just in case.
Yeah. And
Yep.
and it's key, because as your equity in your house grows, then your line of credit that you can borrow against grows.
Yeah,
Right?
what's funny? That's true, but your equity doesn't have to grow for that to happen. So that line of credit growing is not based on the real estate market. It's based on the US Treasuries.
Okay, so explain that.
Yeah, so that's actually pretty cool, because my line of credit could grow beyond the value of my home. So let's say
Wow.
my home today is worth 800,000. I get a reverse mortgage and I'm not eligible because I'm 44 years old, I think. 44, mid 40s, maybe 45. I need to check. But when I qualify, I could probably get, maybe 300,000, something like that, 280, something. I could use that as a reverse mortgage, and even if I don't max out that line of credit, maybe I don't use it to buy a home, I just get that loan on the home that I'm in. And rather than I just set it aside for emergencies. I've got access to hundreds of thousands of dollars worth of cash if I need it. That might be great if I'm retiring off of a stock portfolio and the market drops and I don't want to sell those assets at a loss. There's some really neat tax benefits to how I could use that line of credit as well. Worst case scenario, or best, I don't know, depends on how you look at it, I never use it. But that line of credit is growing based on a rate that is linked to a treasury index plus a margin plus a 0.5% fee. It's not a fee because it's a line of credit growing. There's no loan. I won't go into the details, but there's a couple of different components that make that up. But it's the underlying thing that moves that is an index on US Treasuries. And that grows, and it's never going to not grow. It will never be the same the year before as it was today, but how much it grows is based on that index in the treasury. So if that grows, but let's say I'm living in a market that just gets kind of stagnant, that could theoretically, in fact, it's quite common, it's quite plausible that the amount of my line of credit grows beyond the value of my home, especially if I live a very long time, right? The market's kind of soggy. That line of credit is constantly increasing. The possibility of that line of credit going beyond the value of my home is pretty significant, which is why, so people will sometimes say that, oh, reverse mortgages are expensive. And well, first of all, I want to ask, like, expensive compared to what? Like, if you want access to the equity in your home, it's kind of the only option. But the reason for that is one of the major fees, or costs, I should say, is a better word for it, when you get a reverse mortgage, is they require you to buy an insurance policy that is equal to 2% of the value of the home to cover that upside down possibility. Because if there's a couple that borrows in their 60s, the likelihood of one of them reaching age 90 is over 50%. That's a pretty long time for a lender to not get any payments on a loan, and it's growing. And the collateral is the house. So if it gets into a position where the loan is more than the value of the house, the insurance policy pays that difference.
Ah,
I would never be responsible for that as a homeowner. In fact, I don't even have to die. I could decide that I want to move to Florida or an assisted living community or something like that. And there's no such thing as a short sale. I shouldn't say there's no such thing. I'm just not responsible for that difference. So if my house, if my house is worth 800 now and it's only worth $1 million 30 years from now, but my line of credit or the amount that I've borrowed has accumulated to $1.3 million or something like that, my home, it gets sold and I'm not responsible for that difference. The insurance policy pays the difference. And even my heirs. So if I pass away while I'm living in the home, my heirs have the right to purchase that home for 95% of the appraised value, and the upside downness, the amount that loan is above and beyond the value, if that happens. Like, they're designed for that not to happen, but because we can't predict the real estate market in every sub-market around the United States, there's that insurance policy that kicks in, so that me or my heirs or my spouse, nobody is responsible for that difference. If that occurs, that insurance policy pays for it.
that's
It's a
brilliant.
pretty slick thing. And I do a lot of education to financial advisors and agents about how these work. And once I shed some light on it for them, I have a lot of interesting graphs and visuals. They're like, why wouldn't everybody do this? In fact, I did one Tuesday to a group of financial advisors, and I'm running quotes right now on several of their clients, and one of them was their mom. They're like, my mom is 63, my dad's out of the picture, passed away. I need to do this for her. I don't know why she wouldn't do this. Sometimes people will think like, what if I don't need it? And the bottom line is there's always this opportunity cost, right? If I were going to go, let's say I sold a house in California or something, and I wanted to buy something in Denver to be near my kids or grandkids or whatever. And maybe I sold that house in California for $1.5 million, and what I want to buy here is worth 800,000. Well, I could put $800,000 down. I can afford it. I just sold a property for $1.5 million in California. But if I only put 500 down instead, that leaves $300,000 in an asset somewhere that has some growth potential. Right. So it's not like I wouldn't use that debt because I could afford not to. If that debt accumulates at 6%, but my asset that I was able to leave invested because I didn't use it to buy the home, that $300,000 difference, if that's invested somewhere earning 7 or 8 or 9% over time, I'm getting some arbitrage. I'm making more on that money that I left in my control than the debt is costing me on the reverse. Now that's kind of a complicated, maybe it's not that complicated, I guess, but that's not something that everybody would do. The most obvious examples where people need these is when they're just cash poor. They've paid off their home and they're looking at retirement. They're like, I really would like to retire, but I don't feel like I quite have enough. This can make the difference. Because you
Right.
can also turn a reverse mortgage into monthly income. So you could turn a reverse mortgage into $1,800 or $2,000 a month of monthly income that's guaranteed as long as you live, even if you live to age 140 years old. That could make the difference between whether somebody could retire or not.
So let's look at my real world example. So
Sure.
my house is, we owe 400,000 on it. And we just got our tax valuation, which everybody's pretty upset about right now. And it says it's worth 800,000. So I don't know what percentage is that. So I've got
50%. Did you say 400 and
50%.
800? Yeah.
Yeah, 50% equity. Now, really, if I sold my house, I might be able to get that to appraise even higher in today's market. So the tax evaluation might actually be low. So I think my house is worth 900,000 in today's market. So let's say I have $500,000 equity in that house, and let's see what is that percentage.
5.9. So I can't do that one in my head.
56% equity. And we had our kids late. And so we've got college still to pay for, even though we're getting toward retirement age. So I'm thinking if we got a reverse mortgage and built up, our kids won't go to college for 3 more years, we'll build up some of that line of credit. What does that mean for us?
Well, what I see a lot of people do in that situation is replace their regular mortgage with a reverse mortgage, because then all you do is you just eliminate payments, because you don't have to make payments on a reverse mortgage. It's a debt where the interest accrues rather than requiring you to pay it. You can pay it if you want to, and there are some really neat tax advantages to doing that. We can go into that on maybe a more detailed discussion sometime, but you don't have to. So instead of you paying down that $400,000, that debt just accumulates, leaving that whatever that monthly cost was for you on your mortgage. That's something you could use to pay for college. You could save it for retirement. You could put it aside. Well, it's yours. You do whatever you want with it. So we get it.
We're,
That
go
happens a
ahead.
lot. I'm just saying
We're
that's a common
thinking
thing.
about, if we get a reverse mortgage and have, lose that mortgage, we do have a rental property, and that rental property only has 100,000 left on it. So we're thinking about paying that mortgage off instead, because then that will be income for us when we do retire.
Yeah, we can run numbers in all those scenarios.
Right. Well, this has been a real enlightening highlight of reverse mortgage, and I'm sure we're going to get into a lot more detail, and we're going to get some calls from this. So I
You know what I can
appreciate
do, Marie, also is I
what.
brought this for this conversation. There's this book that I really like that breaks it down into really simple terms.
Oh,
It's
that's
called
great.
Understanding Reverse, written by Dan Holtquist. It's available on Amazon for 10 or 15 bucks or something like that. But it gives a really good explanation in really simple terms as to what are these, how do they work. And if you have anybody that really likes digging into financials and planning and distribution and investing and tax strategies, there's a book by the king of financial planning. His name is Wade Pfau. He's a professor at the college that created and administers the CFP designation. So he knows his stuff. And he doesn't do anything with reverses. He's a financial advisor or a researcher for finance. And he wrote a book on how to use reverse mortgages to secure retirement. This is a fascinating book. It's a bit technical. So for financial people that really want to dig into it, I couldn't put it down because that's kind of my bailiwick. I love that stuff. So those two books give two different levels of analysis on these that I think are fantastic, depending on somebody's appetite, whether they just want to get a cursory understanding of how they work or how to plug them into interesting strategies.
That is great. Thanks, Brady. And so we'll sign off now. This is Marie Jacobs. I'm a realtor, and Brady Mullen, who's a genius. And
All right.
so glad to talk to you again today about something I don't know much about. Thanks, Brady.
Thanks, Marie. It's always a pleasure.